for which it stands, one nation, with liberty.
Roll call.
Secretary Hall.
Here.
Superintendent Bachmeyer. Treasurer Beadle. Governor Rochelle.
Here. Is there a motion to approve minutes from the last meeting?
So moved.
Second.
Discussion. All those in favor?
Aye.
Opposed? Motion carries. Operations.
Morning, Governor, members of the board. I'll go right to my commissioner's report on page 2 of the agenda. The first item would be the administrative rules. As the board recalls, we revised the administrative rules. The board approved those. We took it to the Administrative Rules Committee of the Legislature. Went smoothly there, except for one objection to removing the local newspaper publication requirement for oil and gas lease auctions, which we talked about. You were aware of the newspaper association's objections there. They did have a vote on it. The vote failed, vote of 12-4. So with no other objections, the changes that the board approved will be fully implemented. So any questions about that? All right. That time of year for my performance review. So just to kind of refresh you on the process there, we have a committee that is appointed for the performance review process. Treasurer Beadle chairs that committee, Secretary Howe is on that committee, and then Molly Harrington from Human Resources is on that committee as well. Right now, the plan is for the committee to meet on May 15th. And surveys were sent out yesterday afternoon, so the board and staff should have received those surveys. And then the committee will plan to bring a report to the May 28th board meeting. So any questions on that? All right. You can just
Be
see.
more thoughtful about your review when we're not in the middle of a legislative session.
Yeah. Hopefully that's a good thing.
No, I like, I like, not for this year, but I mean, next year we should actually push it back a month, otherwise we're getting like crazy this year. We
Had to get coffee.
Hi, Drew. Thanks for joining us.
I apologize. Someone spoke too long at the Association of Counties.
Was that someone you?
Claire.
Hey. We're on
Hi.
my commissioners. Still on page 2, my commissioner's report, just an update on the annual conference for the National Association of State Trust Lands that we are hosting in Medora, July 12th through 15th. Registration has been opened. We've been seeing some pretty good people or numbers coming in for registrations. And then we are excited to announce that Ed O'Keefe, the CEO of the Theodore Roosevelt Presidential Library Foundation, a North Dakota native as well, will be the keynote. So he'll be keynoting on the July 14th dinner, the evening there at the library. So we're looking forward to that. And of course, you all have been invited, and I think we've coordinated with your teams on when you might be able to attend. So. And then we, as a leadership team in the department, we have reviewed our core values. A few tweaks to them, nothing major, but made a few tweaks from when we reviewed them a couple of years ago. And then we will be attending a working genius training, it's called, put on by the State Human Resources Department on May 11th. That'll kind of help us prepare for some strategic planning we're going to plan to be doing in the fall heading into legislative session. So the next page is our core values. I'm not going to go through them in detail. You can see communication, integrity, service, team, and excellence. And then we went with kind of taglines for the subpoints to kind of keep them short and punchy. So we can, we're going to plan to put these throughout the office, and it'll be a good reminder for people. So, any questions on that report? Okay, we'll go down to the financials on next page 4. You know, what we all are working for, the main goal here is to continue to grow these trust funds, and happy to report that the Common Schools Trust Fund as the end of January was just under $8.7 billion, which is another record high, up over $1 billion in the last 12 months. So we're excited to report that. And we'll go down to the revenue slide on page 6. As of January 31, you can see that strong investment returns with the portfolio, over 600 million halfway through the fiscal year. So very solid returns already on the investment side. We'll take a little bit of dip when the March numbers come out. And now obviously with April, we're right back up to where we were. So really, when you look at the last 2-3 months, we're kind of back to where we were with the strong markets and all-time highs. So we go to the next page, the strategic investment and improvement fund. You can see the cash balance is 1.16 billion. When you take into account appropriate sent out yet and our reserve fund for litigation, the available as of the end of January was 83.5 million. So, and then going down to the revenues, pretty consistent prior years at this time. And then if you go to the next page, the tax, oil and gas tax waterfall, you can see kind of where we're at there. This is the report through March 31. So kind of slowly going through those buckets, and SIF is at the bottom there. So SIF will start receiving funds when we fill up those other buckets. And then the next slide, 10, our total assets under management. So the change from last month is we did update our surface valuation based on the surveys and the appraisals that we do. And the surface value is estimated to be about 780 million, which was up 43 million or about 6% from last year. So that brings our total net assets that's under landlord management to approximately 12.2 billion. And that's to the fund, so which is another all-time record high. Okay, any questions on that portion of the agenda before we move on to the division reports?
When talking about the distribution from the Common Schools Trust Fund for the integrated formula payments, when is the amount? I know it's based on a formula. When is that?
June 30th.
Will be determined on June 30th.
So the 10% of the 5-year average value as of June 30th of the month. So
I would assume that would always be 1 year in arrears. So we're gonna.
So June 30th of 2026 should set the formula going for the next time.
So we'll know this fall basically what that specific
right
number
there?
is going to be.
Yes, heading into legislative session. I think.
I was assuming for budget construction and just was more wondering about the timing.
If it stays flat from where it is right now, it looks like it's going to be pushed above 700 million for the biennial distribution based on that average. Just over $3,000 per student.
He's the treasurer, so he knows enough.
Glad he came prepared.
All right, going on to the surface report here. 16 right-of-way agreements were processed by the department, generating $362,000 in income. You can see a nice photo of Williams County wildflowers. One of our team members, Kayla. And then we'll move on to the minerals report we'll have Chris Selsley, our minerals director, report on the oil and gas auction we held in March. Chris.
Good morning, Governor Armstrong, members of the board. We had another good auction, less tracks than our last auction that we had October of last year, but still 178 total tracks. A high bid per track for the entire track was almost $1 million, which is really good considering where this acreage is located. So see dots up here where we're leasing. Obviously, it's kind of more fringe acreage. Some of that acreage in Southwest McKenzie County is been pretty sought after. The reason it hasn't been developed right now, though, so far is there's a lot of that federal acreage out there, and so dealing with the feds and getting units set up there is a little bit tougher. So some of that has been available. Now people are trying to get a foothold in there. So that's been very popular. But the total amount of bonus for those leases received was almost $11 million. So that's pretty good for 178 tracks. If we go to the next slide, you can see the breakdown where the most money, we break it down by county. So as you can see, acreage, Southwest McKenzie County really brought that average up. A heat target, I guess, Williams and McKenzie, it's been pretty traditionally strong. We have seen a lot of increase up in the north, like in Burke County, or northern Montreal. So that's been good. You can see on here too, the bulk of that 10 million goes to the Common School Trust Fund, with SIF receiving 800,000, and then there's just a few of the tracks that go to the other funds. And so in the next slide, we always have the historical results. As you can see, on that last row, we had 178 tracks, but we still pulled in $10 million. Obviously, that last auction, we had a ton of more tracks, but they were very interesting. That was more in Stark, slow. They were kind of all over the place. There was a lot of speculation going on, but we still had very strong auction results. As you can see by the bid per acre, we've done really well. And I think that's partly due to auction consolidation, but also, we weren't really in, we didn't have Iran going on and stuff at that time, but it's just renewed. That acreage is more valuable today than it has been. So if you have any questions on that, let me know while I go. Just feel free to interrupt. So go to that next slide. There's just more graphs and kind of, by how we've done per auction. But one of the things I wanted to talk to you about, I don't want to take too much of your time, but one of the things that we've been focused on at the department recently, if you could go to that next slide, we have been really making a concerted effort to make sure that our leases are getting, if they expire under their own terms, we're getting them back into the marketplace and making sure that we're doing a good job of, advertising them, and then working with existing partners to make sure that they're done producing, or, as soon as they're expired on the primary term, that 5 years is up, we're getting them back on in our system again, so people can go and nominate those back and get them. And that's been key to receiving these bonus revenues that we have. The other thing we've done, and which you had asked about, Governor Armstrong too, is the leases that are in their secondary terms. So production's been holding them for a long time. And we've got a lot of old legacy wells that might be, 20, 30, 40, 50 years old. And then they go down, they're not plugged and abandoned yet, but the NDIC is working on them. We're making sure to go out there and say, hey, you're done. Let's get this cleaned up. We're putting our leases out there. We're getting them plugged and abandoned correctly and getting them back into here. One of the things that does, obviously, is the royalty rate increase. A lot of those old leases are 12.5% royalty. Now we're getting them back 18.7. Makes a huge difference for royalties going forward. But also with the bonus we're seeing too. And some of those leases, we're getting, $10 million off of just those 16 and 19 leases that we either deny the extension for, or the secondary term is run out because they had production and paying quantities. So we do, at the end of those 5-year terms for the primary leases, we do take, and we will grant, as long as they're following the terms of the lease and they're drilling or about to drill a new well, we will extend those for up to another year and to allow them to see a return on their investment. But we have denied a few of them because they said, well, can we have an extension? But they haven't really done anything. In most cases, they haven't even got the permit to drill yet. So we denied those, but then those going back into the auctions has obviously been pretty beneficial to the trusts. So
And those bonuses stack up because those are either producing then or very close to producing.
yeah, they're in an
Things,
area.
right? Location, like when you go back to McKinsey and Williams, I'm assuming some of those leases are like very close to producing.
Yes, they're very close to areas that are producing, and then you know that,
Close in time.
yeah, people are gonna want to develop them no matter what. And a lot of the time, the people that have already put the plan together, they have to go back, they'll buy them back in the auction. They'll, you know, it just generates more revenue for us. So,
Chris, I made a note to myself. I'm gonna have my staff reach out to you between now and the next meeting. I'd like to just get some more eyes on just the one-on-one of like what gets these tracks in your process. I'm curious about how you go about it. Are you traveling all over the state all the time? You're not.
no,
Nominate.
yeah, mostly.
Oh,
So
yeah,
these
that's
tracks
process.
that we're
Okay.
luckily, like our process, so when these expire, we're watching the NDIC, we're watching for production. Have we received any payments under the lease that's already there? And if we haven't, then we reach out or we just expire them if we haven't seen any action on them at all. So we're constantly looking at like the NDIC docket and seeing what permits are out there. So we listen into the NDIC hearings or we'll go to them if they're
Yeah.
controversial. And then so we'll expire them. And then a lot of the time, you know, they'll just get nominated back in. We'll turn them off. We'll say this lease is done, you know, but now it's back on.
Yeah.
Of course, the ones where there's an extension or where there's a secondary term, so they've already been producing, then we have to have communication with those operators and the NDIC or whoever to make sure that those aren't producing anymore. Those are a lot tougher because we don't want to, you know, take something away from somebody that has a plan to get more production
Sure.
out of it. Although it is more beneficial to the trust sometimes, but we try to work.
Interesting. Well, I'll reach out to you and
Yeah.
try to schedule a meeting between now and the next meeting.
We can get a more
Great.
in-depth look at like
Yeah.
how that works.
Yeah,
Like,
great. I'd appreciate it.
The key about cleaning this up is people can't nominate them if they don't know they're available. So you get them back into the system as quick as possible. Then people can, I mean, there's this is the admin rules vote, right? Like, I think there's a little bit of disconnect. These are probes, like, there's not a lot of random people just nominating a track to get put into the auction process.
Absolutely.
That's what I was gonna say is that people that want the leases, they follow our website pretty closely. So they can go in and look, pick a particular track and see if it's leased or open. So then if we keep our systems updated better, they can go out and get more real-time info and say, oh, that piece became available, I'm interested, right? So a lot of it is through our website.
The only problem is, you know, that there's 20,000 wells, right? Sitting here watching, and a lot of those are old, like they might have, you know, 5 barrels of production this month and then nothing next month. And then there's 15 barrels. So you have to use a judgment call and then have some dialogue with the operator, what's going on out there. And so we try to do that. You know, we've actually had some of the pros, some operators that actually they're Canadian. But they've asked, you know, hey, is this lease still good up, you know, in Botanow County? So it's not something that makes a ton of production, but it's a good.
Yeah.
So then we will actually go take a look at it. That doesn't happen all that often. Usually we catch them, but there's been times where we'll go in and then we'll have to do investigation.
Which is why you're not responsible for any of these photographs that we look at. This
That's true.
You've never.
I
Been.
would like to get out.
Yeah.
Actually, we're planning on,
Let's go on a road trip. Let's go take some pictures.
we've got one that we can go look at. over in Mackenzie County.
So 3 meetings with Drew, or 2 meetings with Drew this week, and you don't have to come to a conclusion. He's got a ton of free time.
Yeah.
No, I'm trying to get out of the Capitol. Like, don't you want to go take pictures, Chris?
Let's go.
Let's go.
We'll send it on.
A lot of free time.
That could be part of the meeting. We'll
I like it.
All right, any more questions for Chris? Yeah. Hey, thank you, Chris. We'll move on to unclaimed property. Susan, our unclaimed property director, do you want to pop up? and-
Evening, Governor Armstrong, members of the board. This slide is for February, and as we had talked about previously, that was the big push for the direct mailer checks, which was wildly successful. I honestly was quite surprised by the percentage of return. Some of the other states that have done it have worked with about a 25% return mail that came back that have to reprocess, wait, a lot of work. And we're sitting at about 2%. So
We got better data.
something, I don't know, it's pretty amazing. But then if you look at the March slide, Caitlin, or whoever's showing on the slide, we had, and the division paid 1,208 claims with $2.8 million returned to rightful owners. And that is more than we did with the direct mail. And the reason that I think that happened is because of securities related claims. That this shows a dollar value, not necessarily the number of claims made. And we had 3 or 4 really large mutual funds and shares that were returned to the owner. So the value is what's calculated there. So that was surprising to me. I actually didn't believe the numbers when I pulled them. But that's where that number is coming from. And we're also coming up on our life insurance deadline. So we'll see a little bump in revenue coming in.
And you believe that the direct mail generated other interest too, right? Because people were talking to their friends.
For sure. For sure. Absolutely. We had, we're still sitting on about 600 claims in the queue to process, and we were almost up to 1,000 a few weeks ago. So the numbers have been just astounding.
Right about shortly after we sent out those checks, I guest hosted Tyler Agnes's radio show because his dad passed away. And so they kind of scrambled for anybody who could fill that airtime. Apparently I can talk a lot. And so I was on there for a bit, and I had the CEO of the National Association of State Treasurers who helped run the National Association on Property Administrators. So we were talking about a bunch of different issues. But I mentioned the direct mail from the state, and just we got callers coming in saying, yeah, we got our check. It was great. It was fun. It was fantastic. And then we had other people, I pointed them to go to the missingmoney.com website. And so we got other people texting in saying, hey, I just found $400. This is awesome. And so it's, people love it. And the checks really help to get people's eyeballs on it.
Yeah, it's been fantastic. So
Do they just get completely surprised by it, or do you call them ahead?
Well, similar to like Lululemon. So
I was going to say,
so
Thomas, I will always look across this table and feel like I'm $100 richer because of it.
I'm happy. So you guys sent out a letter beforehand.
we
so
did,
people knew it.
we did send out a letter to folks saying here, you're going to be getting a check.
Okay.
Please
Yeah.
cash it.
Yeah.
Well, then they
They
see
think
it,
it's
they
a
don't
scam.
open it, and they think it's a scam.
Right.
Yeah.
So whatever. And then,
Just
so,
deposit your check, send it to the treasurer.
Yeah.
Well, and so they made sure that we knew about all the checks that they were doing. So then we did get a number of people that called our office to say, is this real? So we were being assured them, yes, it was.
Our consumer protect, that's why I asked the question. Our consumer protection division routinely gets calls from people that they're sure they're getting scammed. I'm like, how would you be getting scammed by a $300 check that you're getting from some entity that they just want you to cash? There's no second step. Or
yeah, there's no hidden agenda.
Yeah.
Here it's
No.
yours, and
Yeah.
they don't understand. It's
We'll just catch them out by surprise. So.
and you don't tell them that you take a percentage off that or anything.
no.
Well, and one of the things, so Susan mentioned that in the March one, that there was some big payouts for some security related issues that were coming in. So there's been a bill that's been introduced in Congress by a Democrat out of California and a New York member out of Republican member out of New York that they're calling it the SAFER Act, the Safeguarding Americans Fairly Earned Retirement Act. And what they're trying to do is change the way those securities come to the states. So right now everything gets transferred over to the state unclaimed property after X number of years of them not being able to get a hold of that individual because then it's now unclaimed, it's lost. They're trying to change it because there's many states handle those securities differently when they come in, and it's really being pushed by the crypto guys, where if the gets transferred over to the state and the state says, well, we don't want to hold it in this asset, so we'll take the cash value of that now, and then it will hold that cash value for this person and get that back to them. This congressman is trying to say that no, that because states are trying to take your money because they're going to take the upside gains on the Bitcoin or whatever, they're trying to say that these securities companies cannot transfer it to the state until 3 years after the person dies. So they can just never get reconnected because they're trying to say, well, the state's trying to take your retirement. We're not. We're trying to get you your money back and reconnect you with these lost accounts. And so this is kind of working its way through. It's just been introduced. We don't think it's going to go anywhere, but we are doing kind of a big push nationally trying to say, hey, this is a bad idea. This is going to cause people to not get reconnected with their money because these companies have no incentive to try to reconnect these folks with their money. And so that's just something to make you guys aware of. We're going to push back on it. I've got some letters that I'm going to send to our delegation just so they have some background on it to know about it. We already talked to Congresswoman Fedorchuk about it because I just ran into it. Should be anywhere, but we're keeping.
I get a little emotional over this particular thing.
Well, this guy came in hot on his press release. He was accusing every state unclaimed property administrator of stealing money. He was hot in that press release.
Here's my chicken. The press release.
She's up to, so she's now requested information on how every state is doing their unclaimed property.
This is all the ways that it's just incorrect, the way they're framing it. There was one state, the legislature introduced a bill that they would use unclaimed funds for
Funding a football stadium.
for a football stadium. Well, that bill, yes, it was introduced. However, it didn't pass. It didn't pass. So, and they're making
We
it,
could bring the Bears here.
we could.
You want a pro team?
Yeah, it completely undermines what we're trying to do as far as consumer protection goes.
It's two off-committee members of Congress who introduced the bill. I think
I think we're fine.
I think we're okay.
Yeah. But they're trying to make a bunch of noise on it. And so the National Association has taken a pretty strong stance trying to fight it. So it's up to since this board oversees unclaimed property through land, we'll make sure to keep this board abreast of it. And I'll let you guys know if I send letters. So you can have a chance to sign on if you want. Otherwise, they'll just come from me.
All right, thank you. Any other questions for unclaimed property? And so an update on the legislation.
Oh, I have
She
one
helped,
quick.
she's rocking it.
You have 2% return. I'm assuming that correlates pretty closely to the checks actually being cash.
That we don't know yet. That we will see
That'll be.
probably at the end of, July 1st is when we'll take a real good look at that. Yeah.
Good chunk of it.
All right, we'll move on to the agenda. Next, we've got investments with our Chief Investment Officer, Mikhail. Frank.
They went out, I went, yeah. Oh, he's at 40 years.
Morning, Governor. I'm in the board. Pleasure to be here. I have with me today, Jen Sanders from RDK. Rich, hello.
Yep.
There's Michael Reese from Blue Owl. We also have Kirby Francis from RDK dialed in as well. And I'll start on slide 19. For the investment snapshot. This just a heads up. I'll be going over the monthly snapshot and then I'll be passing it to Jen for the quarterly snapshot. So the monthly snapshot here is as of March 31, and then Jen's going to go over the December 31 quarterly numbers. So as of March 31 here, the investable assets stood at 8.7 billion. That was after about a 3% drawdown in March. Joe hinted earlier since, and at the next board meeting, you'll see that snapshot, we're back to all-time highs, above 9 billion in the investable assets. On slide 20 shows our allocations versus targets, all within range. The sort of outliers there, the underweight in private equity and overweight to public fixed income. And so today's recommendation is one small step in that direction to private equity. On slide 21 shows the flash performance report as of March 31. So you can see in that first column, month to date, shows that what we've seen for the drawdown in March, international equity was down 11%, and the total portfolio was down 3.3% in March. On the 1 year numbers in the bar chart, you can see international equity still the large outperformer on the 1 year period, and all asset classes up, adding positive P&L to the portfolio on the 1 year. On the next slide, 22 shows those uncalled commitments to you can see private equity, the largest share there of uncalled commitments, with our commitments to largely Grosvenor, and then the venture capital managers are typically calling capital. And then on slide 23 shows the liquidity waterfall. No big changes there. Any questions on any of these allocation or performance dashboards? All right, then yeah, I'll hand it over to Jimmy from RBK, and she'll go over the December 31 quarter.
Ms. Frank, Lieutenant Governor, members of the board, good to be with you this morning. RBK's performance report is as of year end. We'll start with a high level market summary, which starts on page 26 in the meeting packet. It was certainly a strong year for risk assets in 2025, despite some pockets of volatility and uncertainty over the course of the year. You saw geopolitical conflicts, concerns early in the year over trade policy, later in the year, a 43-day government shutdown, and largely markets were pretty resilient despite all of the uncertainty over the course of the year. The Fed moved to a slightly more accommodative stance later in 2025. You saw 3 interest rate cuts from the Fed, 2 of which occurred in the fourth quarter, focused primarily on supporting a weakening labor market. GDP for the calendar year 2025 came in just above 2%, so stable, moderate growth over the course of the year. And that was after fourth quarter GDP came in. Expectations were for GDP in the fourth quarter to be about 3%. The early estimate came in at about 1.4% and was revised further down to about 70 basis points for the fourth quarter. And that was largely a result of reduced spending during the shutdown in the fourth quarter. Inflation moderated over the course of the year, closing December at 2.7%, still very much above the Fed's stated 2% range. You saw unemployment tick up just a little bit over the course of the year, closed 2025 at 4.4%, which was up from 4.1 at the end of 24. You heard Frank say, looking out over the last 12 months, equity markets have had a strong year. You saw significant outperformance of non-U.S. markets relative to U.S. markets. About a third of the return outside the U.S. can be attributed to U.S. dollar weakening. The dollar declined about 10% over the course of 2025. Fixed income markets had a strong year. You saw rates fall, credit spreads tightened, and so fixed income returns broadly north of 7%. So a strong year for the capital markets. If you look on the very bottom of page 26, the CYTD column is calendar year to date. Large cap stocks in the U.S. up just shy of 18%, small cap up just shy of 13%, and then markets outside the U.S. between 30 and 35%. So certainly a strong year for equity markets. And then we include a topical slide in each quarterly performance report, and that's on page 27. And I think this looks at a variety of different macro disruptions. And the takeaway here is that despite what could be a pretty meaningful amount of uncertainty over shorter periods of time during different macro events, that long-term markets are driven by business, economic, and investment factors. And so the long-term focus, strategic long-term focus for institutional investors remains key, but there's certainly a lot of uncertainty and the outcomes vary pretty meaningfully depending on the macro event that you look at. But I think then you look out over, call it 5 and 10 years, and returns are largely positive. And this is the S&P 500 that's shown here. But just to highlight that macro events can have a pretty high degree of uncertainty, but long-term focus is what's most important.
How would you term the conflict in Iran right now? Is that a macro? That's not a macro event. That's,
Yeah.
I don't watch much news, but so it's not a duration thing. It can be just months,
Correct.
2 months.
Could be- Correct. And you could see, and it could be longer than a month or 2 months.
Yeah.
Markets could certainly be very volatile over shorter periods of time. Even a year, still relatively short in the grand scheme of things. This portfolio operates in perpetuity. 1 year is relatively insignificant when you're looking at 10, 15, and 20 years of investment history. So a year from now, hard to say where equity markets will land. Yes, very much a macro disruption.
Back one page here. Everything's so politicized now. There's this kerfuffle last year. I think unemployment rates for sure, employment rates for sure. Like President fires a bunch of people because they don't like the way the numbers are coming in. And is GDP part of that too? Like, are we objectively certain of these numbers? Are they just math, or are they?
It's a great question. There, I think, is an ongoing challenge with data availability, and you see those challenges show up in when data is reported and the variation in subsequent data releases. That if most of the data is collected via surveys, survey responses are down. That makes data less reliable. You saw the early estimate for GDP was 1.5% and was basically cut in half after that. So tracking down reliable data continues to be a challenge, I think, across all of the data reporting. A lot of that you saw in the fourth quarter was a result of the government shutdown. An October inflation print was just skipped because there wasn't data to be able to calculate the CPI release in October. So yeah, certainly a challenge. I think you could question the accuracy, and certainly early releases of data are subject to meaningful revision. Jobs reports are certainly that. You see wild swings in the jobs.
No, at least the two biggest job report corrections, one was under Biden, one was under Trump.
Yep.
So.
Yeah.
Yep.
And are you going to go to the performance?
Yes.
Okay.
Yep.
Just real quick before
Sure.
Jen does that. Sorry to interrupt you. I just want to remind the board of a little bit of context of these reports. So the reason why we're reporting, like when we have RVK come do the quarterlies, why we're going back to December 31 is because a lot of the private funds that we have, we don't even get their reports for 2-3 months after the end of the quarter. So we could have her come in February, but we would have only really limited
Public
data.
markets and some.
Yeah.
Yep.
And so that's why we have a flash report that we give a little more real time, that will give you the funds that we have. And most of those are the publicly traded funds that we have more real time data. So I just want to remind the board of why we have kind of the more lagged reporting on the formal report from RTKs.
Yep. Even semi-liquid investments that you have, real estate and infrastructure, are still, call it 6+ weeks after quarter end before they report values. And then you see private credit and private equity in particular are reporting on a much longer lag. So this snapshot on 29 is the asset allocation as of the end of the year. Assets stood at about 8.7 or a little over $8.7 billion. All of your high-level asset classes still within policy ranges. This reflects the asset allocation changes that were approved by the board last summer. So as you heard Frank say, leaning a little bit more into growth. The long-term nature of this portfolio supports a little bit higher equity allocation than you've had in the past, including private equity. but still within policy ranges. And then on 30 shows the performance attribution for the current fiscal year. So the 6 months ending December 31st. So the portfolio was up about 6.75% as of the end of the year. Contributions by asset class are in the darkened bar, so primarily driven by equity contribution, but positive returns from all of the major asset classes so far the first half of this fiscal year. And then on 31 and 32 shows composite performance for the portfolio. So for the fourth quarter, the portfolio was up 3%. Mentioned for the current fiscal year, up 6.75%. And then for calendar year 2025, up 14.2%. So certainly a very strong year. Investment related returns here. The portfolio outperformed both of its benchmarks in the fourth quarter by about 1%, and for the calendar year, about 60 basis points. U.S. equity outperformed for the fourth quarter. The headwinds to performance that you can see, the portfolio underperformed for the year by about 2.8%. That's primarily driven by Jacobs Levy, which is one of the active U.S. equity managers in the portfolio. Jacobs Levy had, to quote them, a somewhat unusual year where, recall, these strategies in the portfolio are extension strategies, so it's a long short strategy. Their short positions performed somewhat poorly this year. Their long positions also underperformed, so an unusual year to see both their short positions and long positions struggle. They were still very much in positive territory, up 11.5% for the year. Jacobs Levy tends to have more of a quality bias. You saw quality pretty significantly underperform other factors like growth and momentum. So that's the primary underperformance for the U.S. equity portfolio. Conversely, your non-U.S. equity portfolio managers had a very strong year. The portfolio was up 37.7%. The two active managers here are Acadian and AeroStreet. Acadian was up 41% for the year, AeroStreet up 39%, so outperformed broad non-U.S. markets by 5.7%.
Jen, I'm going to interrupt you for a second. How, if at all, are for managers, and it's a question for anybody here, how are they impacted by overperformance? The compensation for managers. Is there an incentive for that? Yeah, it's all built into the, you know this, I suppose, but I don't read those contracts.
Yeah, most fee agreements are structured as a flat management fee plus a performance fee.
Okay.
So they are incentivized to be able to align the portfolio to outperform over the long term. Yep.
Okay, makes sense.
And most of the managed ones are, we have, index funds that
Are flat.
yeah, they're just a flat.
That structure is specific to your public equity managers. So Jacobs Levy, AeroStreet, Acadian, all have our extension strategies. They have a base management fee plus a performance fee.
That makes sense.
Other public market strategies are just a flat management fee.
Makes sense. A balance, I'm sure balancing your approach with, you don't want to over incentive, get people to think it's too risky and
Correct.
yeah.
Yes.
Yeah.
There is a balancing act on aligning incentives that you want to see them outperform, but you also want to see some risk discipline within their portfolio approach. Fixed income, the roll-up of both public credit and private credit. Your public credit portfolio is passively managed, was up about 7% for the calendar year. And then your private credit portfolio, managers have had a nice year. The comparison here is to the leverage loan index plus 1.5%. So you're looking for this private credit portfolio to outperform bank loans by a premium over the long term. And then on to 32, absolute return and the hedge fund portfolio. Your hedge fund portfolio had a nice quarter and another nice calendar year of 3.8% in the fourth quarter and 11.6% for the calendar year 2025. That outperforms kind of the broad hedge fund landscape by almost 4.5%. I know I said this either at the last meeting or last year that the expectations for this portfolio are not double-digit returns, that the hedge fund allocation is designed to provide diversification to traditional stocks and bonds. If this portfolio were in the mid to high single digits on an annual basis, that would be considered very, very successful, that you're looking for these hedge funds to perform differently than the stock market and the bond market. So no complaints about north of 11.5% this year after 13.6% last year. But I think it's also important to temper that that's not really the expectation for this mix of managers going forward. The real estate portfolio up 86 basis points for the quarter and 2.75% for the calendar year. You've seen some stabilization in the commercial property markets. There are a couple of managers in this portfolio where full redemptions have been submitted. I think ongoing challenges transacting in the property markets mean that there could be a lengthy period to wait for return of capital from a couple of strategies. And then the private infrastructure portfolio over the year up 10.7%. This portfolio is a mix of primarily open-ended core infrastructure managers with a couple of closed-end strategies, continues to deliver pretty meaningfully positive returns. And I will pause there and see if there are any questions I can answer on the portfolio or markets.
So.
No,
Somebody got that signal.
I don't have-
10% right now.
no, so I don't have a question specifically to this, but I'm assuming we're pretty insulated from, and this goes a little bit to Bruce's question, but Vietnam, South Korea, Indonesia, South Africa, like they're bordering really close on significant, well, they're past the bordering on recessionary trends.
Yep.
I mean, if this continues for any extended period of time, I would say twofold to everybody in here. One, once the market floods with oil, once the strait opens, and if you have like a quarter of the world in deep recession, we're going to see some pretty significant pendulum shifts. But I think that's like, we need to, we're pretty insulated, but people who are on the come on oil are already in rationing stages. And Southeast Asia really bad.
Yep.
Some African countries really bad right now.
And
Even Europe's starting to see it hit some like jet fuel and stuff for planes hitting rounds.
And you see, and I know these numbers are as of year end, but if you were to look at dispersion in markets in March, particularly equity markets, all equity markets were down in March. US markets were down, non-US markets were down a lot more. And that's primarily driven by economies that are net energy importers being much more sensitive to disruption in the Middle East.
Yeah, and some of it's timing, right?
Right.
Like, at least we get the headlines from Europe.
Yes.
Like, they will hit whatever media we're reading. The proximity to
Yes.
where they locate. That's where like the Southeast Asia piece and some of the African countries is in real structural trouble. We don't necessarily, it's not, Europe canceling flights gets covered here. South Korea shutting offices down 2 days a week because they're rationing energy doesn't necessarily get covered here, but that's going on right now.
Yes. I think when you think about portfolio implementation and you look at your non-US equity portfolio, call it half of that or 2/3 of that is actively managed. So you have managers in place who are making intentional decisions to either buy or short certain stocks. So I think the active management approach provides a layer of risk management to have professional asset managers evaluating where the opportunities are. I think for your long short managers, that's also an opportunity to short stocks in markets where they think value will start to go down or is declining already. And so having active management in place, I think, is a meaningful benefit outside the US in your non-US equity portfolio.
Yeah, and I think like from my perspective, trying to spot check a volatile energy market's one thing.
Yeah.
You start actually walking into recession, that's a different conversation.
Yes. Yes. Other questions on markets? Otherwise, I think we can turn it over, or Frank, you want to go through your memo and then Kirby
Yeah.
on the line?
Yeah, we can jump to slide 52. So today's recommendation is going to be for 50 million commitment of geology Fund 6. And so this is to increase our allocation to private equity. GP Stakes is a niche strategy within private equity where they invest in fund managers sharing that revenue stream. So it's a high income generating private equity strategy. And in fact, Kirby dialed in from RBK. I'll hand it to Kirby Francis.
Thanks, Frank, and Governor Armstrong, members of the board. Nice to be here with you again today. We're here recommending Blue Owl GP Stake 6. Like Frank said, this is a niche strategy, something we're really excited about. The portfolio so far has a very strong base of kind of traditional private equity exposure. There's a lot of buyouts under the hood of the Grosvenor account, the Neuberger Berman account we talked about earlier this year that'll be coming online shortly. And then the other main component of private equity is venture capital. Staff and RVK have worked on building relationships with some of the best venture capital platforms in the portfolio as well. That gives us the ability to start to add strategies like Blue Owl, where we think there's a really interesting opportunity because the portfolio already has this great sort of traditional private equity exposure. We're not going to, upset the apple cart with a bunch of these or with over allocations, but we think kind of targeted exposure to these specialist strategies makes a lot of sense. In this case, as Frank mentioned, it's a sector specialist focused on financial services. So investing in private equity firms, the ones where we expect their products are going to grow over time. There's been a lot of success historically, and using that to build a portfolio of these longer duration assets that have a lot of yield, like Frank mentioned along the way, because of the management fees and the performance fees that came up earlier in this call, where when private equity firms invest successfully, they earn carried interest. The Blue Owl will invest in those firms and receive a portion of the carried interest. Blue Owl's been executing this strategy for a long time. They were the first to the market here. We actually looked at this strategy over a decade ago on behalf of a very large, very sophisticated client and have been watching it since then. I think it's a great fit for mature portfolios like the North Dakota and UOL's long time horizon. The risks here, I think, are pretty well mitigated. These are going to be minority investments, but Blue Owl is very good at structuring these. In a minority investment, you have, of course, less control than if you own the majority of the business, but they have well protected in these investments. And then there isn't a specific avenue to exit the investments like there would be in a traditional private equity fund. Blue Owl can go into more detail. They have a number of ways, and now they've demonstrated successfully that they can help clients exit the fund if needed, but the fund does have an indefinite term, which is aligned with that these are assets where we expect them to grow over time and provide income. Overall, we think that's an acceptable risk to take because one, of the long-term nature of the board of University and School Lands Capital, and two, like I mentioned, and they can spend some more time on it if it makes sense, but there's been a lot of success in providing liquidity to investors who needed it as the secondary market in private equity has grown. So for all those reasons, we think it makes sense to move forward with a $50 million commitment here, and I'll end it there unless they're happy to answer any questions on the strategy or RVK's recommendation. Great.
No questions for Kirby. We can jump to slide 61, Caitlin, and I'll hand it over to Michael Rich.
Good morning, Governor, members of the board. Thank you for having us here. Kirby did a nice job of introducing our strategy. So I guess my biggest takeaway is we've been doing this for a long time, making me feel old, and sitting right in the camera makes me feel quite large. But in general, I'm the founder of this strategy. Been investing in these types of assets for 25 years. The picture is a good 15 pounds ago, and really been doing it for my entire career. We are the leaders in this space. We have about a 65% market share. It's a niche space, which, as Kirby mentioned, fits nicely into your core that you've established. We think we can add some incremental return around that core without substantially adding risk. I know we fit under, as Jen said, the risk assets category, but we certainly don't view what we do as a risky strategy. We are very diversified. We'll talk more about the strategy, but Rich, why don't you introduce yourself?
Sure. Rich Pepperone, good morning, Governor, members of the board. Thank you for having us here today. On behalf of the firm, just want to say thank you to you all, Frank and his team, Jennifer and the RBK team for partnership that we've had going back to 2021 across various strategies at Blue Owl. And so we appreciate the opportunity to be here today to continue to build on that with our GP Stakes 6 fund and answer any questions.
So Blue Owl, to flip to the next page, Blue Owl was purpose built. We're approaching our 5-year anniversary, but the components of Blue Owl date back further than that. And it was purpose built to deliver access to private markets, but in a sleep easy at night way. And all of our strategies are yield oriented and downside focused. So unlike a general private equity fund where you spend the first 5 years investing and then your returns will be driven by selling assets over the next 5 years, when you invest in a GP strategy, you get income. And, you know, much like a mineral rights agreement, we don't think of our return as the sale of it at the end of the lifespan. We think of it as the cash flow yield over time. What we do, you know, a lot of different managers, we focus on the ones that are in the private markets. What we do is we buy into their companies. We don't invest in their funds per se. We get exposure to their funds, but we don't invest in them. A lot of these companies are controlled by a handful of individuals, and at times they would like or they require growth capital. So we invest to the tune of about 10, 15, 20%. We buy into their firm, and therefore from the day we come in, we receive our pro rata portion of their income. We'll talk about the components of that income, but in general, it allows us to front load our returns so that you can, like I said, sleep well at night. The next page highlights something we're very humble about. There's an organization, Dow Jones, and an institute in Paris called HEC that rank buyout firms. And last year was the first year we were eligible, and among 695 firms. We knew we were performing well, but we humbly were named the best performing private equity strategy of all 695. And I guess to some extent that says it's sometimes better to own the restaurant than eat the burger. And that is a little bit of, you know, at its core, we were asked that question in a meeting. So after everything you've said, what you're really doing is you're not eating the burgers, you own the restaurant. And ultimately that's it. These are very profitable firms. They're financial services firms. They happen to deliver the kinds of products you talk about in these meetings every quarter. And we are able to buy into their firm and participate in the cash flow that they generate. And ultimately, it's proven out over the last 15 years to be very successful on a relative basis. We have some on the next page, some of the numbers. We won't go into them, but suffice it to say, we do perform quite well. The metrics we care about, not just IRR, which you and return percentage, which you often and everyone talks about. We care about DPI, which is sort of an industry term for
Same.
Yeah. Sorry, same. Okay. Good. All right.
Department of Public Instruction.
Niche reference.
Okay. Yes. Sorry. But our DPI it means how much money have you gotten back in your pocket? That's the easiest way to say it. And you know, when we don't like when strategies are, you know, about planting and waiting for a long time to hope it works out. We want to see yield back as quickly as possible. And one of the reasons we rank so highly is that DPI line is, if not top decile, often top 1% in the industry. What we've done is purchased interest, like I said, about 15% ownership interest in a lot of the firms you see at the bottom. And these are firms that do a lot of different things in private markets, firms that invest in buyout, scratch and dent companies, turnarounds, firms that invest in infrastructure, firms that do energy, upstream, midstream investing. It's a very diversified strategy. if in Fund 6, which we're talking about today, we already have 5 GP stakes in it, about a third to 40% of the portfolio is already identified. RVK and the team have kicked the tires, Frank kicked the tires quite extensively on those deals. But those are the best in class firms in what they do. The fund owns about 15% of each of them, and we'll be able to reap our portion of the profits off of that for a long period of time. These we typically focus on the largest 200 firms in the industry in a way that we can come in, be their partner. We think they'll be around for a long time. So this strategy does have a long duration to it. If we do what we're supposed to do, that cash flow yield, we want it to continue and compound for not just 5 to 7 years, but for even longer. Kirby alluded to the fact that we do have ways to then get your money back to you if you want to exit. But a lot of clients, particularly the ones that have been in from the beginning, they don't want the reinvestment risk. They love keeping the cash flow yield going once the money's in the ground and paying out. Our Fund 3, the first one we mentioned there on the left, is now yielding about 20% cash on cost. So 20% every year in your pocket. And that, in other strategies, when you get a nice distribution like that, it means you sold something. And what you own is getting smaller and smaller because you're selling your assets. This is 20% cash on cost on what we own, but we're not selling. We're just literally getting dividends out of it. And that's what's unique about this strategy. The last page I'll show is the next one.
Rick, I don't mean this is. Seems kind of rude, but I don't mean it that way at all.
We have thick skin.
No. You seem that you're really nice. I'm genuinely wondering though, like what you're describing, and probably because you're so good at describing it, seems pretty simple. Like, what's so great about you guys? Why aren't there 50 people doing this? 50 different entities. And so, what would make you? How do you stand out in that space?
Our next biggest competitor is 1/4 our size. So we are the biggest. We've been doing it for the longest. And this issue of the fact that the fund is not a 10-year finite life fund scares a lot of people off. And in state capitals around the country, if you have a very tight guideline and it says, we need a 10-year fund, we don't qualify. So there are 10 or so states that love us, and state of Minnesota, California, you go down the line. We've been in their program for a long time. But a lot of them, like Pennsylvania and a couple others, just say we can't do it. So the ability for a firm to raise money in this strategy, like we're doing today, is difficult because of the fact that many investors just structurally cannot invest because of their bylaws. You have the flexibility to do it, and you have the time horizon, as talking to Jen about it. You have the time horizon to put that asset on your side and use that to your advantage. It keeps a lot of other investors out. And so when we go to do a deal with any of these firms on the bottom, we don't face direct competition. As the biggest player, everybody's pretty small compared to us. We've been doing it the longest. So when a really good firm wants to take on a partner, there's a 90% chance they pick us. Our market share is about 90% in those larger deals. So that gives us some pricing power. And we could say, we'll give you just enough to make it attractive and for the manager to want to do it with us, but not so much that our returns go down. And I think over time, we've been consistent over the last 10, 11 years to do deals that are almost all the same in terms of the price we're paying.
I would stress the sourcing that you and the team have done across 15 years is also an obstacle for others coming into the space to build the relationships that Michael and our investment team have with the GPs that we've bought a stake in and the prospective GPs that we will hopefully partner with going forward. And we've had very, very low turnover on this team. A handful of people over 15 years, and that's a distinguishing factor of our business.
Interesting. Well, that was so good. People will think it was like we went to college together.
Thank you for that. Yes.
That was pretty serious
question. Yeah.
Appreciate it.
And then one more page, and then we'll stop with page turning. This is what we are entitled to when we buy into one of these GPs, one of these money managers. We're entitled to our, let's call it 15% share of each of these three items. We are able to buy into their management fees, which are very stable and cash flow generative. So when you think about management fees, if a firm starts a new fund and it takes 10 years for them to manage it, we get our portion of the management fees for all 10 years. Every time they raise a new fund, that gives us another 10 years of future cash flow. So that gives us a very nice sleep well at night baseline yield. Then the other two areas where we generate cash flow are their performance fees. As you alluded to, most of the GPs in our space do get a performance fee for when they do well. And we get our portion of that too. Now that may be a little more episodic if it was just one GP, one firm. But if we have a blended group of a dozen of firms and each firm has a half dozen funds, you can see how those performance fees, while episodic on an individual level, begin to smooth out over time. And then the final piece is that as we give them money, that initial investment, they put that in their funds. And when they put that in their funds alongside their investors, we are invested right in those funds too. So we do get a little bit of the underlying fund exposure as well. And you know, why they do that? Your question earlier was a great one. What they have the drive to outperform because of the performance fees. How do you make sure they're not swinging for the fences? And the way most managers convince clients is they say, well, I'm going to put 100 million of my own money into this fund alongside yours. We won't swing for the fence. If you were just incentivized by the performance fee, you could see a incentive to be more risky. But if you have your own money invested right alongside investors, that's going to sort of modulate that a little bit and make sure what's good for the client, good for you, and develops that long-term alignment of incentives. So those are the three cash flows. They all mix together and give us that yield-based return that we're exposed to over time. And our ability to get these high-quality firms at the right price is what generates the type of very good returns that we've been able to do, and we think will continue with Fund 6. Fund 6 is already marked up. It's a 1.2 already, so you're 20% in the money, so to speak. We're finalizing the fundraise over the next quarter or so. It'll be a $13 billion-ish fund, and we'll identify, in addition to these 5 GP stakes we already have, call it another 10, and then that will be the 15 firms or so that we all collectively own together, and will participate in their profits over time. Pause there or stop there if you want to move on. That's it in a nutshell. And appreciate your time being with you in the recommendation.
Questions?
Yeah. So, and I know this is one of the equity funds, and I think the strategy is smart, makes sense. I'm all for it. Question that I have. Blue Owl's obviously been in the news lately just because of the private credit squeeze. It's kind of been going on a little bit. Different side of the ledger than the equity side, but they go hand in hand because private credit tends to lend to these private equity firms, so market firms. And so, I know that Blue Owl, like the main company, that like their stock down like 40% year to date. It's up 10% today because you got beat earnings, so congrats. But it's still down 40% year to date. And so, what are you seeing with what's your perspective on what's happening with private credit? I know JP Morgan in March wrote down some of their loans that they had because they saw some of the software equity stocks that they were into went down. And so they wrote down some of the loan value portfolio as well. So what are you guys seeing in terms of coming out? My perspective on it is I think it's overblown. I think it was retail traders that jumped into private credit without knowing that private credit needs patience. And so they tried to jump in, jump out. Those retail traders is what's kind of caused the panic. But I'd like to know kind of your perspective on that.
Yeah, and thank you for your question and your investment alongside us in our private credit strategy. What we do in our private credit strategy, and what most other private credit managers do, is we try to generate a couple hundred basis points, 200-300 basis points more than the high yield market because we can be patient, we can lend to a very diversified group of underlying borrowers, and we have time on our side. We have done that for, the industry has really grown since 2009, but it's grown without a credit cycle. There haven't been a lot of defaults, bankruptcies, et cetera. So what has happened in the last 4 or 5 months, starting in November, is people, predominantly the media, which sort of caters to the retail investor, has said, what if AI eats the world? And what if AI makes every company in the world go bankrupt?
Every time Claude had a new widget, then the software stocks tanked it.
And we would tend to agree strongly with you that it is overblown, and that part is more of a media sensationalist story. What we know is going to happen is that AI is an amazing technological advancement. It will disrupt industries, lots of them, and it may disrupt the software industry more than others. But what we and our peers in private credit do, we lend a small portion of the total value, usually 30-ish%. The very high quality investors put in the 70% equity. And, we trust and partner with them to do a good job of running those firms over time and ultimately selling them. In any lending market, you will have losses and defaults over time. What I think what you're referring to with our stock performance today is we reported that we don't see anything yet. We think we're not, sort of ducking our head in the sand and saying there won't be, disruption based on AI or other things. And we will ride that with others, but there is not our phrase, not red flags or red lights flashing going off. We are seeing good underlying earnings growth of our portfolio, our borrowers, and even our software-oriented borrowers are 10% up on a year-to-year basis in their profitability. So I think you're spot on. It's there. We're mindful of it for sure, but it's more of a press-driven cycle than anything. Our strategy that we're talking about today, our BOWS strategy, our equity strategy that you're in, and our very diversified lending is all sleep well at night. We'll have our hiccups. I'm sure others will too, but I don't see major concern. And our GP stakes business that we're talking about today is really off to the side of that.
And I guess why I said that it doesn't affect this strategy at all, but since it impacts the company as a whole, that's where I was just kind of curious about that.
Yeah.
So thank you.
Thank you.
Any other questions?
I don't have any.
Frank has his memo on page 52. Frank, you want to?
Yeah, I'll ask for a motion on slide.
So I would move that the board approve $50 million commitment to the Blue Owl GP Stake 6, subject to standard review, legal review, and documentation.
Second. Discussion. Roll call.
Strong, like it.
Secretary Howell?
Yes.
Superintendent Bachmeyer?
Yes.
Treasurer Beadle? Attorney General Wrigley?
Yes.
Governor Armstrong?
Yes.
Thank you.
Keep making us money.
And thanks to everybody who worked on, I know it gets vetted before it comes here, and I don't mean to suppose otherwise with my question. I was just curious, and I appreciate the answer to that, but I appreciate the work that everybody does to vet the folks that you bring in here, because we get really good presentations and good information. Thank you.
Thank you. Thank you.
Thanks.
Thank you all.
Thank you.
Another pivot to strategy now. So
That's right. That's right. I'm gonna get on the phone right after it.
Dominating their own track.
That's right. That's right.
All right, we have one more item on the regular session agenda, the litigation update on page 86. I'll go ahead and address that. So the first case, the MHA versus the United States Department of basically where we're at with that is trial has been scheduled to start on September 1st. I think the expectation is for maybe 2 to 5 day trial, depending on how long things stretch out. And right now, basically, the parties are going back and forth on retrial stuff. So just kind of the attorneys going back and forth with getting things organized and working with the judge to make sure everything is set for trial itself. Next one, the Leland case. We are still waiting for the North Dakota Supreme Court decision. As you recall, we had oral arguments on that in February. So we have not received a decision on that yet, so. And then the last one, the ordinary high watermark quiet title action. Basically, we have been having some pretty good back and forth with the federal government on that. There was an extension to April 29th. Just heard yesterday or 2 days ago that we agreed to another extension to May 29th. So there's a lot of detail on there. There's a lot of specific work along examining every tract along the river, and whether it's public domain or not, and whether there's federal ownership, whether there's not, whether there's federal leases on it. So there's just a lot of detailed work that both sides were fine with giving another month on that. So any questions on those cases?
Yeah, feds done fighting with the feds. They're up them yet?
Not yet.
This is gonna be perhaps a dangerous question, but following Drew's, the Attorney General's courage here, why has it taken the MHA Nation case so long to get to this point? I mean, we were talking about this when I was in the governor's office in 2016. And I understand there's been changes in administration and M opinions, Q opinions, all sorts of different types of opinions, but it seems like this is a pretty foundational question that we're just now, years later, actually starting to take to trial. And so I just,
biggest thing was the federal government was resistant to litigation because they have certain protections under the Federal Quiet Title Act, where they can exercise sovereign immunity to defend themselves against quiet title actions.
Okay.
But finally, to make a long story short, we were able to intervene in the original action, and then that was appealed up to the circuit court. The circuit court basically said, federal government, why don't you just file a federal quiet title action, because this needs to be settled, right? And so that kind of gave them the cue to, okay, we should probably, so really the federal government had to waive their sovereign immunity, and they finally agreed to that action after it got to that level. So now the federal government is like, let's settle title. So the federal government is still deciding, I think, which side they come down on, because you have Interior Department that.
No, the federal government's fighting with the federal government.
Yeah. But at least it is now going to go before a judge for title determination. Sure. So I think that's the important thing. But I think it was because with all the machinations back and forth about, which administration was in place, and finally the federal government said, fine, we'll waive our sovereign immunity.
So politics and bureaucracy.
Yeah.
Okay.
Yeah.
And there's been, it hasn't sat dormant. This hasn't just sat there.
Right.
Like there have been the quiet title stuff, the different sovereign immunity stuff. But from the perspective right now, really all it is who's going to call the expert witness.
Right.
Like if the feds decide to change their opinion on the M opinion, that doesn't mean the experts that they had when they had the other opinion aren't going to be called. They're just going to be called by MHA. It's an expert witness.
It speaks to the broader issue that, when I started here 4 years ago, we had a really long list of cases being litigated. There's a really long list, and the staff has done an excellent job of resolving so many matters that were pending. But I think I think it's important, incumbent upon all of us to always be looking around for opportunities to resolve these matters, because they change administrations, like you're saying, it just sets everything back, and it might turn the whole thing on its head. It happened here again. This could get delayed again. I hope it doesn't. Doesn't look like it will, but it just is a matter of philosophical approach. And I know the governor and I have had some conversations in the last month or so about a couple of other matters that pertain to this, looking for ways to really resolve these things short of litigation, not because any of us is afraid of litigation, but we're probably uniquely situated to understand it's uncertain a lot, and not to mention it's costly, and it doesn't really end there so frequently. Like when that list that has been resolved over the last several years really moves the needle and moves the state forward in important ways, because we haven't signed off on any shoddy deals. It's all transparent for public instruction, but that's why they have elected officials on these boards to make those assessments on behalf of the state, not, not, just a bunch of lawyers or accountants sitting here doing it. And so it does speak, is your question's a great one. And when I first got here, I was hearing from the board, like, what are we gonna do?
Right.
This list is expensive.
How much money is in suspense on this case?
Oh, gosh.
At least so. And the people developing it want one thing. They want certainty.
Certainty. Right.
Yeah, exactly.
One of the weird things about this part of it is it's really a fight between us. They're paying 20% either way.
Right.
I mean, they're paying 20% either way.
They just want to know who to write the check to.
And one of the things with our, with the litigation that we do have, like the ordinary high water mark, the only reason that lawsuit exists is because, we're protecting ourselves with statute of limitations things. And that gives us an opportunity to preserve that we go and talk to them as well.
Sure.
So we're trying to resolve without going.
While preserving optionality.
Right.
Sure. That makes sense. Thank you.
There's some historical cases in North Dakota where that wasn't done that have been problematic since.
Absolutely.
Thank you.
Yeah. Yes. One of the easiest things to do is to persist with litigation sometimes because you're not wrong. Like you're just putting it off and like, oh, the court's going to decide. Oh, we'll see what the jury says in this thing. And I've known prosecutors like that across the years do things like they don't want to make a difficult. It's like, do it. Just eat it.
Yeah.
Do it. You got a problem with your case, or there's some other thing involved. And this is. I'm not pointing to this case saying that it cries out for what I'm discussing, but it is incumbent upon all of us to always be looking for ways to shorten this long, protracted, expensive, uncertain litigation.
It's also a perfect example of why changes of administrations matter, depending on which way they decide to go. I mean, you have a previous administration who proffered expert witnesses that this administration may no longer want to use. Like, I mean, it doesn't mean they're not going to testify because somebody's going to want to use them.
Right.
Like, and and the next extension is really so they can figure out which position they're taking. Now we know where we're at. MHA knows where they're at.
And I apologize. Did I say the 11th Circuit? I meant the DC Circuit. On the MH.
Yeah.
I meant the DC Circuit on the MH. I'm sorry. I misspoke.
Yeah.
All right. Okay. If there are no other questions, that's the end of what we have for open session. We do recommend going into executive session if the board is open to that.
89.
Fair.
Page
89.
It is. Well, your binder, Attorney General, becoming an anti-tech zealot, so you're actually pretty cutting edge right now.
I don't need the Chinese knowing about my binder.
How much time you're spending on each thing?
They make it full of printers.
All right. All right. Under the authority of the North Dakota Century Code sections 44-04-19.1 and 44-04-19.2, I move that the board close the meeting public and go into an executive session for the purpose of attorney consultation and to discuss negotiating strategy regarding the Little Missouri River indemnity selections and royalty settlements.
Second. Discussion. Roll call.
Secretary Hall,
Yes.
Superintendent Faulkner,
Yes.
Treasurer Beadle, Treasurer Ridley,
Yes.
action.
Yes. This executive session will be recorded and all board members are reminded that discussion during the executive session must be limited to the announced purpose for entering the executive session, which is anticipated to last approximately 45 minutes. Board members, their staff, employees of the Department of Trust Lands, and counsel with the Attorney General staff will remain, but the public is asked to leave the room. The executive session will begin at 10:30. And will commence with a new audio recording device. When the executive session ends, the board will reconvene in open session. Granted.
spent a year of my time.
The disc in my back, and it took me 8 months to get all the muscles back.
The engineer is so bad.
I still don't have one of them. It's not that it's not. I can run. I couldn't run.
It just atrophied so bad, yeah.
It was, the muscle was literally not getting any signal.
Yeah.
I would try to run leg would flex.
You have to have surgery for each surgery.
The dry needle where they stick needles in there and basically jump start like a car.
Hey, we're live now, so.
I think they just came out.
He's that's for 90.
The executive session has ended at 11:28 a.m. At which, and the public has been invited back into the meeting room. The board is now back in open session. 2 litigation matters were discussed in executive session. We'll start with the first one, which is the Little Missouri indemnity. What are the board's wishes?
Mr. Chairman, I'd move that the board authorize the commissioner to send notice to the federal government to preserve our legal rights on this issue.
Second.
Discussion. Well, we can't discuss because it was executive session. Roll call.
Secretary Howell.
Yes.
Superintendent Bachmeyer.
Yes.
Treasurer Beagle.
Yes.
Attorney General Wrigley.
Yes.
Governor Armstrong.
Yes. The second issue was royalty statements. What are the
Yes.
Board's wishes.
Governor, I'd make a motion, consistent with the guidance, that was provided during that discussion. Guidance to the staff, parameters of, moving forward with the continuing efforts to resolve that matter. I would make a motion that the staff do so, consistent with the, provisions that you, provided, in that executive session. And with thanks also for your leadership on that.
Sorry.
Roll call.
Secretary Howell.
Yes.
Superintendent Bachmeyer.
Yes.
Treasurer Beagle.
Yes.
Attorney General Wrigley.
Yes.
Governor Armstrong.
Yes.
Thank you.
Next meeting is May 28th, but I will see Joe and his crew in Medora before then, right?
Nope,
It's
that's
after
in July.
I have so many things I'm going to Medora for.
No, that's
Okay, so that's July. Yep. I'm going to Medora today,
No,
tomorrow.
today. No, you're right, today.